Hey guys, welcome back. Here we are working on Chapter 8, Master Budgeting. Um, a budget is a plan. The old adage, people don't plan to fail, they fail to plan. And that's true. In any kind of a business, you have to have a goal, you have to have a budget, you have to have a plan. Now, I was taught a long time ago by some really elite project managers that budget we know is wrong. We know it's wrong. It's a guess. It's a plan. It needs to be an educated guess. But the question is, how badly is it wrong? We don't want to always miss. You don't want to be too high. You don't want to be too low. You want to be about right. Budgets are not perfect. You can't forecast the future, but uh, you want to get better and better at it. And a lot of times you use past historical data as you end up creating it. But um, let's talk about why and how budgets organizations create the budgets. So a budget is simply a detailed plan for acquiring and using resources over a specified time period. Why the organization creates budgets? They have planning. They want to set financial and operational goals. They want to align the resources with those objectives, and they need to plan for it. The control. It provides a benchmark for performance evaluation and variance analysis as well. We need to know how we did. So we need to plan, you need to shoot for it, and you need to figure out how well you did. Um, Coordination ensures all that the departments work towards the unified organizational goals. And motivation, it encourages accountability and performance improvement as well. How budgets are created. There's a top down approach. Senior management creates a budget with limited input from lower levels. There's a bottom up approach, participative budgeting. It involves input from various departments. It improves accuracy and increases employee buy in. So think about that. As you're sitting here, talking about a different budget, the senior management could either lay it out and tell everybody this is the way it is, or they can go down to the weeds, and who really knows what's going on better than the people in the weeds, anyways. So you go down there and you talk to them about different things that are going on. You really need to involve everybody when you're trying to make a budget. Then when they say, "Hey, yeah, I think I can hit this goal," it promotes that buy-in that you need within an organization. So that's important. Um, so a master budget itself is a comprehensive financial plan that ends up consolidating all individual budgets to reflect the overall operational and financial goals of an organization. The key characteristics, it covers a specified time period, often a fiscal year. It integrates all the functions, budgets, sales, production, cash into one singular cohesive plan. The components of the master budget. There's operating budgets. These focus on revenue generation, operational activities. And then there's sales budgets. How much we're going to sell, production, how much we're going to produce. Well, depends on how much we think we can sell, and direct materials. There's also financial budgets. These focus on financial resources like cash budgets, budgeted income statements, budgeted balance sheet. When you're preparing the master budget, it's the steps. So step one, there's the sales budget. You got to estimate future sales revenue based on the expected sales and volume and price. The formula would be the sales revenue would equal your budgeted sales units times the selling price per unit. So, example, a company plans to sell about 10,000 units at $50 each, and they have sales revenue 10,000 times $50 would be $500,000 of sales revenue. Um, Production budget. This determines the number of units to produce to meet sales and inventory needs. So the formula would be your required production would be equal to your budgeted sales plus your desired ending inventory minus your beginning inventory. So you already started with something, you want to end with something. So what's the difference? That plus your budgeted sales units will be what you need. So if sales are 10,000 units and desired ending inventory is 2,000 units, and the beginning inventory is 1,000 units, the required production would be 10,000 plus 2,000 minus 1,000 equals 11,000 units. Would be your production budget. You need to produce 11,000. When we look at our direct materials budget, This would estimate the materials needed for the production and their costs. So the formula here would be like the materials to purchase, or materials required for production, plus your desired ending materials inventory, minus your beginning materials inventory. So if the production requires 22,000 pounds of material, desired ending inventory is 5,000 pounds, and beginning inventory is 3,000 pounds. The materials to purchase will be 22,000 plus 5,000 minus 3,000 equals 24,000 pounds. That would be the amount of direct materials that you would want to, uh, or you would need in order to do the production and their cost. Then you've got to also look at the direct labor budget. So this estimates the labor hours and the cost needed to meet production goals. The formula would be your direct labor cost. It would equal your required production, your labor hours per unit, times your hourly wage. The example would be like if production is 11,000 units, each unit requires 2 labor hours, and the wage rate is $20 an hour. The total labor cost would be 11,000 times 2 times $20 equals $440,000 of direct labor that will go into that. So you need to staff appropriately. The manufacturing overhead budget. So this estimates all indirect production costs, and the categories would be your fixed overhead, which would be like your depreciation or rent or something like that. The variable overhead, which would be utilities based on different production levels. So if you're producing 10,000 units, your electricity is going to be a lot more at 100,000 units than 10,000. You got to consider that. Step 6 would be like finish your ending finished goods inventory budget. So here you want to calculate the cost of ending inventory for use in the financial statement. So the formula will be your ending inventory value equals your units in ending inventory times your unit product cost. So you just have to value what's left by what it's worth, and that's really your historical cost. You value inventory at the lower of cost or market per gap. So lower of what you paid for it or lower of what it's worth. You either write it off or it's what you paid for it. So selling and administrative expense budget. So this estimates non-manufacturing expenses related to operations. So categories would be fixed expenses such as salary and rent, and variable expenses such as sales commissions based on sales volume. Um, your cash budget is another one. So this projects your cash inflows and outflows to ensure sufficient liquidity. Cash is king in a business. You don't track your cash, you're going to go out of business quickly. Um, so this is going to have a cash receipts section. This is collection from sales or other sources, and a cash disbursements, which would be payments for materials, labor, overhead, and expenses. You'd also have a financing section, which would be any borrowing or repayment plans if cash needs are unmet. So, example: if cash inflows are 600,000 and cash outflows are 550,000, the ending balance would be $50,000. That's really how that is put together. Budgeted income statement. This summarizes expected revenues and expenses to estimate profitability. So key figures will be revenue, cost of goods sold, operating expenses, and net income. Step 10 would be a budgeted balance sheet. This would project the organization's financial position at the end of the period. Key sections would be assets, liabilities, and equity balances based on budgeted activities and changes that you're estimating. So ultimately, that's sort of going through a master budget at a high level. And you'll have to dig into it and really get in there to understand how the mechanics work. But this sort of helps give you sort of an overall picture of what you're trying to accomplish and where it's going. So this really, the budgets like this help align resources with the goals, and it provides a framework for planning, control, and motivation. The master budget will integrate all the operational and financial budgets into a single comprehensive plan. And preparing the master budget involves sequential steps from forecasting sales to projecting the financial statements. Master budgeting also enables better decision making, ensuring that organizations achieve their strategic objectives efficiently. Guys, that's the end of this chapter. I hope that helps. If you have questions, you're not understanding this as you're going through it, just reach out. I'm always there. I hope you have a great week, and we'll talk to you next time.